Hey guys, welcome back to Andrew Invests. A great day for stocks today. Meta has just reported earnings after the bell, and the stock is up nearly 18% in after hours trading at the time of recording this video. So that's nearly 20% for the day as a whole. The Fed also decided to raise interest rates by only 0.25%, which meant that risk sentiment is a lot more positive now. Risk stocks pumped today. Personally, with the Meta news, it's not what I was expecting, but it proves it's impossible to time the market, and that the best way to invest is basically to own high quality businesses that will perform in the long term. Let's go through the key takeaways from Meta's earnings without further ado, and we can also discuss the impact of slowing interest rate hikes on stocks. Okay, let's get straight into the earnings. So, interestingly, Meta's still calling themselves Facebook in their earnings reports, despite the company name change. So, some of the key takeaways from this report is that compared to the fourth quarter of 2021, revenue is down 4%, costs is up 22%, income's down significantly. Margins are down, taxes down. I guess that's a good thing in some regard, but is mostly probably because the profits are down, so they're obviously not paying as much tax from that. And just the net income per share is also down. So on the face of it, this would look very negative, but you have to take it in context. So for example, analysts were expecting a much bigger revenue drop than this, so this was actually positive news. And also, if you look at revenue growth without accounting for FX, there was actually had foreign exchange rates remained constant with the same periods of 2021, revenue would have been $2.01 billion and $5.96 billion higher, an increase of 2% and 4% on a constant currency basis for the fourth quarter and full year 2022, respectively. So a lot of tech stocks and American stocks that have a lot of international business have been dealing with this same effect. I tend to agree with the perspective that you should use constant currency basis, since fluctuations in FX rate can really vary year on year. In fact, this year there may be the opposite effect due to the Fed starting to taper off their interest rate increases. With the costs and expenses going up so much, I think there is a good explanation for that to some extent. There was a huge amount of restructuring done by Meta in December, where they are effectively letting go of 11,000 employees out of a total of around 80-something thousand. So in order to do that, they've had to pay a huge amount of severance fees to their employees and various other fees for that. So I think that cost them, it cost them around $4.5 billion roughly. So that really ate into their profits as well. And you can see that as a one-time cost, and it will actually pay dividends in the future, in the sense that there will be less employee costs quarter on quarter, and that will show positive starting in the next quarter's earnings report. If you look at share repurchases, this is really positive for shareholders. Meta has repurchased $28 billion worth of stock in 2022, with the stock being at such a low price compared to previous highs. You're effectively, every stock that you own is now worth a higher percentage of the business, and it's by a significant amount. When a stock is cheap, that's when you especially want a company to be doing buybacks like this, and that's certainly the case right now. This definitely negates by far any stock issued by the company to pay employees as well. So the total share count will be going down. And finally, as I mentioned previously, the head count of Meta will be shrinking significantly. It increased a lot this quarter because the employee cuts have not yet been put into the headcount numbers yet, but that will be the case for the next quarter's earnings. As you can see, Meta, raised their employee count by 20% in 1 year, which is a huge amount, and in my opinion, definitely unnecessary. There was recently a letter from Mark Zuckerberg to shareholders where he talked about the need to focus on efficiency and, make sure that the business is much more streamlined. And I think that's a really big positive for the company. And this cutting of employees, although sad for the employees themselves, was definitely needed. And I think it's going to be actually a very positive sign for Meta for this year. Something I wanted to bring to your attention, which I thought was quite interesting, is the income losses from the Reality Labs division of Meta. So there's previously been a lot of investor concern about the losses taken by the Reality Labs division. A huge amount of research and development spending has been happening on VR headsets, the metaverse, AR headsets, things like that. And those losses have accelerated this year in 2022 compared to 2021. Even in Q4, the spending, went the loss went up by 25% from 3 billion to 4 billion. As a total for the year as a whole, the loss from Reality Labs went from 10 billion to a loss of 13 billion. So it's a pretty huge amount of money being lost on this venture, with no real sign that this will become profitable in the future. I think even more worryingly, the revenue brought in by Reality Labs has actually decreased year on year. In 2021, Reality Labs brought in 2.2 billion, whereas in 2022 it brought in 2.1 billion. So with the amount being spent on this division, you would expect it to at least have growing revenues. Even if losses are increasing, you would expect sales to be picking up at least. So that really worries me, to be honest. Even if you look at the Q4, where lots of VR headsets are going to be being bought over the Christmas period as gifts and whatnot. There was a pretty sizable decrease in revenue compared to the last 3 months of 2021. And so Mark Zuckerberg, has really, made VR his pet project, and it still remains to be seen whether it will have any legs to it, really. However, in the positive news, if Meta was to realize or decide, VR is completely pointless, we're going to drop it completely, all of these losses would, become effectively free cash for, the shareholder, and could be turned into buybacks, although I do think that's unlikely. So in addition to the earnings report, Meta also announced an additional $40 billion for stock buybacks in 2023. That's an increase on 2022, and I think it's been really welcomed by investors, including me, who have been calling for this kind of thing for a while. It may be seen as bad by people in politics who may increase the pressure on Meta for various different things, since they have just let go of 11,000 staff, and increasing buybacks is not a very it won't win you many friends in DC right now. Let's just say that. In my opinion, ultimately a business should be run for the shareholders and not the employees, unfortunately. And this is the correct decision, in my opinion. The stock price is low and Meta should be buying it back whilst it's low. It's, a business is run, for the profit of shareholders. But yeah, that's just my opinion. So to round off the video, I wanted to talk quickly about the Federal Reserve rate decision today. They raised rates by a further quarter point, as opposed to the 0.5% that we've become used to over the last few months. On the removal of the possibility of a 0.5% increase, markets rallied, and risk assets, kind of bounced pretty heavily. So Bitcoin, chip stocks, things like that. However, in the meeting, Jay Powell did talk pretty tough about inflation. He was quite hawkish still by his words, saying, that they had to focus on making sure that inflation was gone fully. However, by his actions, you can see that they're already starting to taper off their rate increases. And I think there's an expectation that by the end of the year, the Fed will actually start dropping the interest rates as inflation will be dealt with. It remains to be seen whether that's actually true, although the trend for inflation has been downwards for the last few months at least. And in general, interest rate increases have a delayed effect of around 6 months before they actually can be seen in the economy. So I think that personally, inflation probably will start coming down, and with the interest rates coming down as well, it's a real positive for the stock market. Interestingly, the Fed and the markets are actually expecting different things when it comes to how interest rates will go this year. In December, the Fed was projecting a peak interest rate of between 5 and 5.25% this year, and no cuts, for it to basically be maintained throughout 2023. So quite a hawkish view. But the markets are basically unconvinced. They're expecting the peak rate to go to be below 5%. And actually have to be cut by the end of the year. So a much more dovish outlook. That disconnect between the Fed and the market will really play a large role in deciding how the stock market performs this year, and we'll just have to wait and see what happens. But that's it from me now. Thank you for watching my video. Please subscribe and like the video if you liked it, and I'll catch you guys next time.